Hello everyone, welcome to another video for CFA Level 1. In today's class, we will be starting an absolute new topic in portfolio management, and the name of the topic, as you guys can see, is Portfolio Risk and Return Part 1. Why Part 1? Because in your CFA curriculum, Portfolio Risk and Return is divided into two readings, Part 1 and Part 2. So we will take up both of them separately. Today we will start with Portfolio Management Risk and Return Part 1. Now, before we start this topic, let me make one thing very clear. For this topic consists a lot of numerical concept, a lot of numericals in place, and it is a paradise for those who like maths, right? But don't worry, guys. Those who are not good in maths, I am here for you. I'll make each and every concept very easy to understand, very logical, so it will not come hard on you. Okay, guys. So let us start. The first topic, more from an introduction point of view, tells us how we can classify an investor. So basically, portfolio management says that investors can be classified into three categories. They can be either risk averse, they can be either risk seeking, or they can be either risk neutral. So under this classification, we are dividing the investors basis their affinity towards the risk. Okay, their liking towards the risk, whether it is risk averse, whether it is risk seeking, and whether it is risk neutral. What is risk averse? The one who dislikes risk. So people who are wanting to stay away from the risk, who don't like risk, are known as risk averse. The one who prefers more risky investment or have an affinity towards the risk, right, basically like the risk, are known as risk seeking. And the one who are indifferent between a risky and a risk free return. So basically these guys are more interested on the return pursuant to the risk, and they are not totally focused on the risk. Okay, then we have an example to understand what is a risk seeking investor, what is a risk neutral investor, and what is a risk averse investor. Okay, so what it is saying, suppose there is a gamble. Okay, winner, and the gamble is a coin toss. Okay, now we both know coin toss has only two possibility, heads or tails. Yes or no? So the winner has a probability of 0.5, whereas a loser has a probability of 0.5. Yes or no? Okay. Suppose the winning price is $200. Winning price is $200, and there is nothing for the loser. Okay. So we have already done in the binomial model what will be the expected payoff for this event. We have already understood the concept of expected payoff. So what is an expected payoff for this event? The expected payoff for this event will be probability of winning into the winnings plus probability of losing into the losings, which is $100. It is the expected payoff of the event. Yes or no? Okay. So till now we understand this example. Now this $100 can be split between three investors. Okay. One who likes, one who would like to directly take $100 without gambling. Okay. So basically, when you give an option to him that either you can flip a coin, okay, where the expected payoff is $100, or you can directly get a $100 bill, this guy will select the $100 bill and not go for a chance of earning $200. This guy is known as risk averse. Okay, so he will always prefer not to take risk. What was the risk over here? The risk was losing in a gambling, so he will prefer not to gamble at all. Then there is another extreme. Even if you offer him the chance to get $100 bill, but he will go for gambling. Why? Because although the expected payoff is $100, but there is always a chance to win $200. Correct? There is a chance for a higher return. So this guy is known as risk seeking. While there is a third category of person who is indifferent between gambling or directly taking the money. Okay. So what he will see that the expected payoff from gambling is also 100. This amount that I am getting directly is also 100. So I am indifferent in my approach. I can either take the gambling option or I can directly take the $100 bill. This guy is known as risk neutral. So based on the affinity of a person towards a risk or based on his liking towards a risk, the investor can be classified either as risk averse or risk neutral or risk seeking. Are we clear? Are we clear, guys? How an investor can be classified? Okay. This was the basic, uh, basic introduction about how an investor is thought from a portfolio management point of view. Now, the next two topics that we will be doing is very important, and it is very important not only from the theoretical lens, but also it will carry on with you forever in your life till the time you are doing finance. Okay. And they are different sides of the same coin. The one is the return related concepts. The other is the risk related concepts. So as a portfolio manager, you not only need to understand the returns associated with a particular investment, you should also understand the risk associated with it. Why? Because why understanding risk is important? Because you don't know what your investors would like. Correct? It is possible that your investors will not only go after a high return investment, they might be risk averse. So it is important to understand what risk profile of the client is, as well as what kind of risk and investment possess. In order to understand the kind of risk and investment possess, you need to understand the risk related measures. Correct? That is why these two are very important concepts for you to understand from a portfolio management point of view, and definitely from the finance as a whole. First, we will understand the return related concept, and second, we will understand the risk related concept. In the return related concept, we will understand the various measures of return. Okay. Why various measures? Because different measures are appropriate for different kinds of investment, different time horizons for which the investment is kept, and different, the ways in which you need to compare an investment. That is why we have different measures of investment. For risk related, we will understand the various associated concepts with it. Various associated concepts with it. Okay. So now we will start various return concepts. Okay. The first is holding period return. What is a holding period return? Guys, we will understand each and everything in details. What is a holding period return, guys? The holding period return says the return that you earn over the period for which you have held the asset. So, for example, if you have bought an asset in year 0 and held it till year 2, then the return which you have earned in this 2 years in totality. Okay, the return that you earn over these 2 years in totality is known as holding period return. So basically, for example, if you have bought it at 100 and sold the asset after 2 years in 150 at 150 rupees. So your holding period return will be nothing but you have earned 50 by an investment of 100, which is 50%. Okay, so what we can say, over a 2 year period, the person has earned 50% on the investment. Okay, so it is not annualized, it is the total return that you have earned for the entire period for which you have held the asset. Okay, see what is the what how do you calculate it? What is the formula? It is capital appreciation plus dividend or interest. So basically it is nothing but capital appreciation plus intermediate cash flow. Now if you invest in a stock, you will get dividend. If you invest in a bond, you will get a coupon payment. If you invest in real estate, you might get rental income. Correct? That is why what we say, that over the period for which you have held the asset, what is the capital appreciation, guys? I don't think after so many videos making for you, I need to explain what is capital appreciation. So I'm assuming that you are aware about it. Okay, so over 2 year period, uh, when you have to compute the holding period return, you add capital appreciation, that is the value of the asset going up, with any intermediate cash flow with it, divided by the invested value. Basically, $100 in our example, $100 which became to $150. So this 150, this 50 is the capital appreciation, and this 100 is the invested value plus the intermittent cash flows. Okay. The second is the arithmetic mean return. What is arithmetic mean return? Suppose, what is arithmetic mean return? Suppose rather than investing in just one asset, a person invests in multiple assets. Correct? This is possible. A person can make multiple asset investment. Yes or no? Now asset 1, asset 2, dot 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 asset n. There can be multiple asset. Asset 1 will give a return of R1. Asset 2 will give a return of R2. Similarly, asset AN will give a return of Rn. Yes or no? Multiple asset, multiple return. What arithmetic mean return is saying, that what is the mean return of all the asset? Mean return of all the asset. So basically, in a very loose sense, what is the average return you have earned on your assets? How it is computed? It is computed as sum of individual return divided by total number of assets. Sum of individual return divided by total number of assets. Are we clear, guys? Are we clear? I hope this is simple. The third we are talking about is the geometric mean return. So geometric mean return is similar to arithmetic mean return, but over here, rather than loosely saying what is the return, we will be more precise. So geometric mean return is nothing but a simple geometric mean R1 into R2 into dot 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 Rn to the power 1 by n. Okay, where n is nothing but total number of assets. R1, R2 and Rn is nothing but return on individual assets. Are we clear, guys? Then we go to the fourth point, money weighted rate of return. What is money weighted return? Over here, see what is the difference between the money weighted return and the arithmetic return. You need to understand. In the first case, what we were doing is that we were computing the return on the individual asset and then we were doing an arithmetic mean for it. Then we were computing the mean for it. When we do this, we are ignoring one important factor. See, you need to understand over here. When we are taking different assets, their return and then doing an arithmetic mean for it, we are ignoring one important factor. We are ignoring the absolute amount of investment invested in each of the assets. So let me take an example. Suppose you earn 50% return on one asset class, whereas you lose just 5% return on the other asset class. Okay. Suppose you earn 50% return on one asset class. On the other asset class, suppose you lose 5%. Now, if you take a arithmetic mean out of it, you can say in a loose terms that my arithmetic mean return is 22.5, which appears to be very good. Correct. Now, let me add further details to the question. Suppose I say that in the investment where you have earned 50% return, you just invested $100. Whereas in the investment where you lost 5%, you had invested $2,000. So now let us see how much of return in actual terms you get. In 100%, in $100 of investment, you have earned 50%. So you have earned $50, correct? In a $2,000 investment, you have lost 5%, correct? Which means you have lost $100. So minus 100. In reality, you have actually lost $50 in the process. So by investing $2,100, you have lost $50. Correct? Is it good? Is it bad? Is it, very bad? Correct? However, this conclusion you would not have been able to reach if you were just considering the arithmetic mean return. Why? Because in the arithmetic mean return, we are ignoring the fact as to how much of investment was made in a particular asset class. And that important aspect is covered in the money weighted rate of return. It takes into the fact that how much of investment has gone into it and how is it computed. It is computed as the IRR of the portfolio based on all cash flows and cash inflows and outflow. Present value of cash inflow should be equal to the present value of cash outflow. So basically what money weighted rate of return is saying is that the IRR, which is nothing but the internal rate of return, is computed. Now, what is internal rate of return? Let us take an example. Suppose at point 0, you make an investment of $1,000. Okay. Since you are making an investment, can we say this is a cash outflow for you? Since you are making an investment, money is going out from your pocket. Can we say that? Yes, we can say money is going out from our pocket. Suppose in the subsequent years, I earn out of it. Suppose I make $400 in the first year, I make $500 in the second year, and I make $600 in the third year. Okay. In totality, I make $1,500. Correct? Are we clear till this point? What your holding period return will compute is that it will be 1,500 minus 1,000 into 100. So you will say your holding period return is 50%. Why? We will say intermediate cash flows divided by the initial value. Correct? Can we say that our holding period return is 50%? Yes. But what IRR will do is that it will say that if I have to compute the present value of year 1 cash flow plus the present value of year 2 cash flow plus the present value of year 3 cash flow, this should be equal to my $1,000. Now, what is this concept of present value? Why we are computing it? If you want to understand more about it, there is a topic known as time value of money. And don't worry guys, you don't need to search anywhere else. In my classes, in the initial part of the classes, in quants, there is a 3-4 lecture for time value of money. I would suggest you go through it. It will make your concepts really clear about time value, and then come and watch this, you will understand. Okay. So what I was saying is that the rate at which the present value of year 1 cash flow, present value of year 2 cash flow, and present value of year 3 cash flow is equal to my $1,000, that rate is known as IRR, and that is nothing but the money weighted rate of return. So over here you will see you are giving the appropriate respect and weightage for the amount of investment made or the amount of cash flow which is happening. Why? See, $1,000 cash flow is given the appropriate respect. Year 1, year 2, year 3 cash flows are given the appropriate respect, right? So money weighted rate of return gives the appropriate respect to the amount of investment that you make in any investment. Okay.